One of the best ETFs on planet Earth is QQQ, which has a 10-year average return of 17.38%. VGT has a 10-year average return of 19.6%. And VTI has a 10-year average return of 11.15%. Having those three together in a supercharged portfolio full of heavy hitters would be making you bank with returns like that. On average, between the three, that's like a 15% return. And if you were investing just $500 per month with a return like that, in 25 years, you'd have over $1.3 million off of just investing $500 per month. To make returns like that, you're gonna wanna make sure and cut down on any mistakes in ETF investing. And in this video, I'm gonna go over 3 huge mistakes and how to fix them to be a very successful investor. The first has to do with what I just started with, and that's looking at just total return. Here's the thing about looking at just that total return though. While each one of those ETFs at the beginning of this video were solid ETFs, and each one of them had obviously an amazing return, picking only the top ones with the highest returns for your portfolio total may be a huge mistake. When we look at those first 2 ETFs, the first one was QQQ, and as you can see here, it's huge in technology. Over 57% is all technology. The top 10 holdings are reputable names like Apple, Microsoft, Amazon, and Nvidia. But when we look at that other ETF, VGT, we can see that it is full of all information technology. So while QQQ was 57%, this 100% is information technology. So you're getting the same thing in 2 different places. And when we look at the types of companies that are within VGT, we see Apple, Microsoft, and Nvidia again. And specifically the percentage of the fund, 40% of this is in Apple and Microsoft. So when we look at these 2 and we look at this overlap between the 2, you can see that 33% of QQQ's holdings are also in VGT. As far as weight, about 50% is weighted between the 2. So this means that you're basically buying the exact same thing or very, very similar to the same thing, just paying for it in 2 different places. If you're buying QQQ and it has a high amount of Apple and Microsoft, and then you're buying into VGT who has a super high amount of Apple and Microsoft, you're kind of just buying the exact same thing but putting your money in 2 places, like I said. This isn't necessarily a huge wrong, but it could be. And the way some of you are doing it definitely is. Now yes, there's going to obviously be a bunch of overlap between a fund whose big priority is technology, which is QQQ, and then one that's literally called a technology fund, VGT, so you can see the similarity there. But one that a lot of people kind of forget about is when you're having that foundational type ETF, one like VTI. Most people have either VU or VTI in their portfolio, and then they add things to it. So when we look at QQQ versus VTI, we're gonna see that there's still a huge amount of overlap, especially by weight here. 93% of QQQ's 100 holdings are already in VTI. So if you have VTI and you're buying QQQ, you already have 93% of that in your VTI exposure. You can also see down here that we have a bunch of overlap in specifically these companies: Apple, Microsoft, Amazon, Nvidia, and Google. But the mistake is not what some people would make you think. There's a lot of people that think that fund overlap just by itself is the bad thing, and that is incorrect. Just because you're buying something that you already have a little piece of over here doesn't make that bad, especially if the company's good, right? Like for me, I really like Apple and Microsoft, and I want a bunch of that in my portfolio. Those are the 2 biggest companies that we have, and 2 of the strongest, and long term I see them having competitive advantage. So I want a lot of exposure there. So it's not fund overlap that's the problem. The problem comes when you don't understand what the overlap means and how it actually affects your portfolio overall. Main takeaway from this point number 1 is that you need to understand that you do have fund overlap if you have it, and then how much of it you actually have. So in the example that I've gone through so far, we looked at QQQ, VGT, and VTI. As long as you understand all of the holdings within all of them, and then how much of a percentage you actually own, and which ones are higher weighted than others, that's gonna be important for you moving forward. because you should understand that in each one of them, you're buying into Apple. In each one of them, you're buying into Microsoft and Nvidia. So then if you're looking to invest in individual companies and you want to add stock to that ETF portfolio, it's probably not the most beneficial idea for you to add another share of Apple or another share of Microsoft because you're already so heavily weighted with what you already have. But if you do your research and you just really like that company and you are totally fine having of your total portfolio 50% be Apple, that's not the craziest thing in the world as long as you understand that that does have a little bit higher risk. But the best investor to do it does have a portfolio with a very high amount of just Apple. So understand what's in your portfolio, understand what fund overlap is, and then make your decision off of that. The next mistake in number 2 has to do with diversification as well, but this is one of the biggest mistakes that I definitely see happen all the time. It kind of piggybacks off the first one because traditionally, the way to invest, the most optimal way to invest, was this idea that you should have very little to no fund overlap whatsoever. And so diversification is very important. And so if you're investing in two things, they need to be totally separate things. Or at least that's what they used to say. And this was the idea of that old 3-fund portfolio that did work for a while, but nowadays we have an update. But anyway, everyone agrees that a portion of your portfolio should be US equities or US stocks. And that would be a broad index fund like the S&P 500 or the total US stock market. That's the first part of the 3-fund portfolio. Then in the old 3-fund portfolio, they wanted something that was also stocks, but totally opposite from that first part. So if the first part is US stocks, the second portion needs to be non-US stocks, so just international exposure. Then the third part of that fund is totally different than the first two because the first two were stocks, so this third one is not stocks and it's bonds. Now, obviously the problem with this old 3-fund portfolio is the fact that we've seen the data over the last 20 years and it's not so hot for those last two pieces. VXUS would be that international ETF, and over the last 10 years, the return has been about 3.7%. And as far as the bond returns, the BND ETF return has been 1.3% per year. Those are awful. So my goal, just like wise investors and specifically Warren Buffett, is not to be the most diversified investor of all time. You don't get a prize for the most diversification.
We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably. Because there aren't that many wonderful businesses that are understandable to a single human being in all likelihood, and to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness. You know, do I need to own 28 stocks in order to have proper diversification? Be nonsense. And
the goal should be the best return with the best long-term safety as well. The goal should be consistency and sustainability. My new 3-fund portfolio is the updated version of that old 3-fund portfolio and has been absolutely crushing it and will continue to for the foreseeable future in my opinion. I'll link to this video below and also cue this video up at the end of this current video so you can watch it right away. But this last common mistake is by far the biggest. I just told you about fund overlap and to look out for that and watch your portfolio to make sure you don't have too much, or to at least understand what and how much of what you are actually invested in. I also just said that you should stop worrying about having the most optimally diversified portfolio in the whole entire world and more so be concerned with long-term results. So the common mistake I see here is that people start to realize that maybe their portfolio is wrong or it's not the most optimal possible, and so they keep changing it up, and they keep changing it up every month or every couple months based off of something new that they just learned. The change is not the issue, but the method is. Now just keep in mind, I don't know what else you're invested in. I don't know your overall goals for investing, or at least your goals for investing in this particular portfolio. I can't sit here and tell you you should have this ETF or you shouldn't have this one, because each one of you has a different investing outlook. For example, REITs are amazing, especially for dividend investing and bringing in crazy cash flow and passive income. They bring far more than good solid dividend stocks like Johnson & Johnson or even the best dividend ETF in SCHD. But I choose those safe, boring dividend companies or SCHD over REITs for me personally. So if I were to make a video on my 5 favorite dividend investments, these types of REITs probably wouldn't make it into that video specifically. But it's not because the REITs aren't a good investment and that you shouldn't invest in them. I just leave them out because I already invest a fair amount of my portfolio in real estate. I have 2 actual rental properties, and that makes up about half of my total portfolio as far as money invested. So if I were to add REITs or more real estate in that form, that would just overload and increase my risk to be having so much in one sector. The biggest mistake anyone could make in this investing world is just to take somebody else's word for their investments or look at their investments, just copy it without doing any extra research yourself and not understand what it is that you're investing in. You need to understand not only the investment itself, but also what your total goal is with your portfolio. My 3-fund portfolio is the best place to start because especially if you're new to investing or you need to revamp your investment portfolio and get it rebalanced, these 3 is where 90% of my stock and ETF portfolio lies and gives you all the great things that I talked about in this video, especially a monster long-term return with consistency and safety. Check out this video now for a more in-depth explanation.